With Vetri Subramaniam, let's understand what he makes of the current macro and the micro setup and how essentially one should be investing in this kind of a scenario. Vetri, it's been a year where news has been rather dynamic. The market has seen a complete contagion impact of the Adani sell-off, and the news on the macro front. One day it's recession, one day it's inflation. Is slightly confusing. Connect the dots for us. What are you watching? What is on your radar? How would you stitch the scenario?
Yeah, sure. Thanks for that. Good to talk here today on ET Now. So yeah, I'll just step back because, the news flow is way too erratic. But if you think about what's been happening since, early 2022, we've seen this very sharp increase in interest rates, obviously led by the US Federal Reserve. But, banks, central banks across the world, be it Europe and of course even in India, rates started to move up very, very sharply. I think the initial response to these rates moving up was felt predominantly by equities. Of course, it was also felt by bonds. But in equities, stocks really responded to higher cost of money with the high growth, high PE stocks starting to obviously come under pressure as the valuations get taken down, adjusting for a higher cost of capital. But I think where you've sort of now reached the point in early 2023 is where we now have to worry about what do these higher rates and what are the intentions of central banks in terms of hiking rates. The intention is clearly to slow down the economy, to cool down the economy, to fight inflation. And that at some level obviously means slower growth. You look at India, we've got slowing growth compared to last year based on the forecast from government. You look at US as well. I know the economy has been slightly stronger than what people anticipated, but the US Federal Reserve is simultaneously arguing that we'll meet every sign of strength in the economy by keeping things tight perhaps for longer in an attempt to slow things down, get inflation back to trajectory. Now, when you've got all economies slowing down, you've got to start worrying about the second leg of what it means, which is not only asset prices getting hit by interest rates, but real growth and earnings starting to get hit by much tighter monetary policies, and in countries like India, much more disciplined fiscal policy as well. If you look at the March 23 earnings estimates, Nikunj, over the last 6 months, they've already come down by about 5 to 6%. We've now got just high single digit earnings growth forecast for March 23. But if you look at the Bloomberg consensus numbers for March 24, it's been almost unchanged for the last 6 to 8 months, which is slightly mystifying because if you've got these visible signs of growth coming down, then it's a little hard for me to believe that FY 24 earnings estimates will remain unchanged. So I think we are in the second leg of what started in early 22, where we have to worry about what it means for earnings growth, and there's a risk to earnings estimates from everything that's happening. The third element is really one of risk to financial system. We saw a little bit of that, if you recollect, a few months ago, particularly in UK, where the bond market really sort of panicked. But I think, perhaps at this point of time, I would rate that risk to be very low. In India, we've certainly got a very strong financial system, the best that I can think of in almost 15, 20 years. And in the US as well, most signs are that the financial system is very strong. So if there are problems, I expect them to be more Europe centric and perhaps even Japan, because the yen for long has been a favorite funding currency. So, those are the three legs in which to think about the market: derating of asset prices, risk to earnings, and financial risk.
What is your understanding about the domino effect Adani group of companies could have on the market per se and also on the lending system per se? It's not a specific question on Adani group of stocks, but the domino effect it could have.
Interesting question, Nikunj. Yeah, I won't comment on the group or the stocks, but just to point out that I think foreigners have been investing in India for nearly 30 years. The best of my memory, in 1992 is when they started, and they have seen all kinds of events in India, right? I mean, for every company that went down, and I won't take their names, but the companies where we had accounting scandals, where we had scandals relating to settlements at stock exchanges. Then that ricocheted into the fact that companies were also connected to that, and some very high flying companies through the 90s, through the 2000s, and even the early 2000s, then met their comeuppance. And then we saw another round of companies which again went through a very difficult period. Many of them ended up in IBC and transfer of ownership after the GFC. So, bad corporate governance and good corporate governance exist everywhere in the world. I would, really point at this time to say that I'm not saying somebody is good or bad. All I'm saying is that sophisticated investors know about the risk they are dealing in the companies in which they are invested. And they will not interpret market risk based on risk that may be talked about in some other enterprise. So I think I would not worry too much about this in terms of the fact that it changes the way foreign investors would look at investing in India. They've been doing it for 30 years. They've seen scandals come and go. And as I said, in this particular case, we still don't know what, the end result might be.
On a relative basis, Vetri, do you sense that the India underperformance, relatively albeit, to say markets like China or other EMs may continue for some more time?
That is possible. If you think about, I just break up the last 15 months into two periods. January 22 to October 22 is where markets like India, Indonesia, Brazil did very, very well. Markets like India, Indonesia, perhaps it's the structural story which held them up much better. But going somewhere into October 22, November 22, you actually saw some of the markets that had derated quite significantly, where cyclical pressures were the maximum. Those markets have got a bit of a leg up over the last 2 to 3 months. But I think the structural argument for India remains intact. But I think the bigger challenge for equities is really coming from the fact that for the first time in more than a decade, bonds are starting to figure in asset allocation plans of any asset allocator, be it a global asset allocator or an asset allocator sitting in any geography, right? This era of zero interest rates, negative interest rate yielding bonds is, I think, very clearly behind us. The entire interest rate curve has moved up. And I think what we are seeing at some level is the pressure where asset allocators are saying, okay, for the first time in a decade, I'm able to get a reasonable return on my fixed income instruments. And therefore, how should I think about my allocation to fixed income? For almost a decade, there was no alternative. You couldn't get anything in fixed income. So to my mind, there are two things we need to think about. It's not just about, is India attractive? It's that for the first time, asset allocators across the world are actually starting to find interest rates a reasonable alternative within their portfolio. And to my mind, that's creating a bit of a drag in terms of allocations to equities in general. The flip-flopping of cyclical moves will keep happening, but I think there is a reasonably strong undertone in the way foreign investors and certainly domestic investors look at India and its structural prospects. And I don't see that changing anytime soon.
Vetri, hi, morning. What about the outlook when it comes to the capital goods sector? Because no doubt we've seen consistency in terms of their financials. We have seen as well that their order books have been growing. But then there's that challenge as now valuations have become expensive.
Well, that's a fabulous question. You put the context across perfectly. I'll just, make 2 points here. One is, to my mind, corporate balance sheets very healthy. So, entrepreneurs' willingness to invest should be good. Capacity utilization has moved up. I don't think it's still at the level where entrepreneurs are, stretching or realizing that their plants can't move, can't raise output any further from existing plants, and therefore they really need to put capex in the ground today. And B, remember that the global growth environment is still slightly, hesitant. We are seeing whatever is happening across the world. So to sum it up, I don't think entrepreneurs have very strong animal spirits at this point of time in terms of ramping up capex, simply because everything that's going around the world is holding back those animal spirits. And the final point which you made is very relevant. Industrial stocks have surprised me by how well they've done over the last 12 to 15 months. I wouldn't have expected this if we'd had this conversation a year and a half ago. But I think at these starting valuations, it becomes very difficult for me to take a long-term constructive view, because I think a lot of the potential is in the price. And I do think there is still a problem as regards the animal spirits of entrepreneurs and their willingness to invest.
Vetri, good to have you as always. Thanks much for joining in.
Thank you.